manage a couple of funds with a fund co-manager. I do have a book out. When you get a chance, stop by. I think I have a couple of copies left. And I do have a podcast called Big Mike Fund Podcast. And we invest, as a fund, we invest in two lines of business. Short-term bridge loans, and we also do value-add equity projects, and I'll talk a little bit about that. Let's talk a little bit about, this is a 30 minutes presentation which I gotta give now in less than 8 minutes, so it's gonna be tough. Just remember, when you're investing and we are speculating, know the difference. Benjamin Graham, this is what he said. You can read this, but investment gotta have a safety and a reasonable rate of return. Speculation is your Bitcoin and such. Remember that return on investment plus return on your time is your total return. So if you're getting into a project that requires a lot of work, just make sure you understand the implications of return on time in addition to the return on investment. Typically elements of the return. So return comes from two sources essentially. One is cash flow, two is appreciation. And appreciation comes in two forms, natural and forced. Forced is what happens when you do rehab on a project or build a project up. Just make sure you know the difference. And on top of that, you have tax benefits. When you invest, just know what you're investing for. You can invest for growth, you can invest for income, you can invest for growth in income. So just be aware of the differences between three types of investing. This is the key slide. So just be aware that the market is at the peak of the economic expansion. We're likely going to see recession. Those of you who follow yield curve and know what it means, it's the difference between 10-year treasury and a 2-year treasury. It's a very strong leading indicator to a likely recession. So when it happens, recession is not guaranteed, but mathematically pretty likely. So we will likely have, if the yield inverts later this year, the yield curve inverts, we're likely going to have a recession in 2019 and or 2020. We don't know how severe it's going to be, but just got to be prepared for that. So be aware that most of the asset classes are fully priced. There are still some asset classes as good bargains and opportunities, but most of the market is fully priced. Cap rates are historically low, and the interest rates are rising. And there's an Amazon fear factor. A lot of retail is actually trading at a significant discount to the reconstruction cost, and there are a lot of opportunities in the retail sector because Amazon has eaten their lunch. But it's not all retailers. Service-oriented retailers are a phenomenal opportunity versus the big box retailers. The residential construction is still hot, the entry level. This is still an area of decent momentum play. And one of the things that we are seeing across the country is this non-reported inflation, asset inflation, commodity inflation, while the incomes are rising modestly. So when you invest in 2018, you got to picture opportunities. I'm going to talk a little bit about momentum play. So momentum play is you're just still following the market that's hot and has been expanding. The new housing development is still hot, especially entry level. The high-end stuff is stalling and has reversed, and in many markets has dropped. So be aware of the high-end stuff, stay away from the high-end, and entry-level development could still be a good opportunity. There's all kind of interesting opportunities to take over existing projects with rents below the market where you can actually take advantage of the rent increases and other value add. Many opportunities exist in taking over a project with an existing mortgage that was taken out the last couple of years when the rates were lower. Turnkey properties, there's a lot of discussions on that. The yields have gotten worse significantly. And from personal experience, I can tell you that the theoretical yields, what you get sold on, are not what you get because of the repairs and other issues. Just be aware of that. There's still opportunities in land purchases fill in. Value add. Value add is different strategy than momentum play. You're taking advantage of the forced appreciation, building value in projects rather than relying on the market to move you up. So typical value add type of projects have increase in occupancy, increase in rents, creating additional income from additional sources of cash flow. Some interesting project, there's a humongous trend in the whole United States and many markets for conversions and redevelopment of old retail big boxes into projects like self-storage. There are a ton of opportunities, and the right investment could be very, very lucrative. An old retail mall could be sold for half the price of reconstruction, and self-storage can come up and be a phenomenal cash flow play. So there are also a ton of Amazon-resistant retail that are selling at historically high cap rates and have a ton of value add. A lot of REITs are shedding those assets, and it's a contrarian play. Let me talk a little bit about that in the next slide. So contrarian play is taking a position when everybody's running, you're going in. And retail is a scary sector, but if you enter into the right retail centers with REIT selling and you buying at a high cap rate with great leverage and great cash flow, and you have a ton of opportunity to sell out parcels, add value in other manner. So what you're doing is you're taking a little bit of risk of Amazon effect, but at the same time, the cash flow and the value add ensures that you will do well in the long run. There's still risk of Amazon. Keep in mind that they're still expanding, they're still doing more projects and more development of their business. Understand your risk. I can't stress this enough. So whenever you're investing, think about diversification. That's your number one way to mitigate risk. So what happens when the interest rates are rising? The primary strategy in the rising interest rate environment is to refinance for longer term and reduce leverage. So what's very interesting is if you go to a bank and the bank offers you 6% rate and 75% leverage, ask the bank, what rate would you give me if I take 70% leverage or 65? So if you borrow less, they're going to give you a better rate. So you improve your cash flow significantly. You do need to have a little bit more equity in the deal, but it's a very powerful technique. Focus on cash flow, ignore the value. If the project is cash flowing and the market goes into recession and the values drop, you couldn't care less. The cash is the king. And also go into a project that have multiple exit strategies. So exit strategy could be a refinance, and exit strategy could be a sale. And invest in the recession-resistant sector like self-storage is one of the examples. Affordable housing, entry-level housing, and projects with forced depreciation. Again, best investment advice. Diversify, diversify, diversify. You can't go wrong with that. Focus on cash flow. Focus on area of lower volatility and high predictability. Use conservative leverage. So de-lever. When the market corrects, instead of taking more risk, take less risk. And what matters is not the return, but risk-adjusted return. A little bit of comparison when you're considering individual deal versus a fund investing. I'm a fund manager, so I'm going to cover a little bit on this subject. So individual deals have high risk concentration and higher volatility. Typically, when you invest in a fund, you diversify immediately, instant diversification among the assets of the fund and have lower volatility. Typically, funds, depending on the type of fund, they may have better liquidity than the individual asset because when you buy something, your money is stuck there for a while. What we do is no personal guarantees. Occasionally you have to deal with personal guarantee. Non-IRA deals, you might have to sign a personal guarantee. You may have potential liability risks. Typically, funds, when they invest, they have limited liability. Investment in a fund is completely passive. When you invest in active deals, you have to be active. The other interesting comparison is you could have idle funds between investments. When the loan repays, you got to find another deal to deploy the money. When you put the money in the fund, the money is always working. You may have a UBIT if you are investing IRA with debt leverage. Just be aware of that. On a fund level, we have no leverage, so we have no UBIT. And when you invest in individual deal, you must have the right amount of capital. When you invest in a fund, it can be much more flexible. You can invest some money and then add over time. A couple of words about our fund. We are a growth and income fund. We do value add equity investments, fix and flip projects. We pay 7% pref, total return 10 to 13. We've been running above that, but I just want to put a word of caution. We're trying to be as conservative as we can and set the right expectations. The 10 to 13 is our general target. This is the way to find us, tempofunding.com, bigmikefund.com.